All right. How's it going, friends and family? Welcome to another episode of the Compounder's Corner. In this video, we'll be going over the companies that are reporting their earnings this week, and we'll be talking about the stock market in general. And in case you missed it, some videos that were recently uploaded onto the channel this past week, we did two videos. One was a YouTube short giving an update as to why the health insurance stocks are rebounding, such as Humana, CVS, and a big shout out to SCHD for buying big into United Health prior to the rally. They always get it right. I'm not even kidding. They apply the principles of Warren Buffett value investing, and they buy big into companies that are undervalued. In the short term, it feels like they're wrong. But in the long run, SCHD is almost always correct. Not always, but statistically pretty good. And then the second video was a long-form discussion as to why dividends are useless. And I'll be honest with you, it ruffled up some feathers, and I'm okay with that. I'm also going to be working on a video this week, which is a stock analysis request. That'll be uploaded later on. I'm not really sure. I'll be working on it here and there. Pretty busy these days, just to keep you guys in the loop. That's what's been going on. And now let's turn our eyes onto what we've got going on for this week. So as you can see on your screen right now, the big banks are going to be reporting. When we talk about Morgan Stanley, Bank of America, we got PNC, M&T, Charles Schwab, not really a bank, but they're still in the financial sector. Citizens, BlackRock, Citi, First Bank, Goldman Sachs, and JP Morgan Chase. I would deem them to be S tier out of the entire bank bracket, which means we'll be finding out the financial health of the consumers, businesses, and everything else money related. The more activity, IPOs, mergers, investment banking, and everything, and loans being conducted, the better they will be rated. Personally, I think banks, as of right now, are a little too expensive, and I wouldn't look to dollar cost average to open a position. But the regional banks, I do think there's some value there, although I don't think they're the best deals on the market right now. So I'm not putting any of my money towards the banks right now. And then we also have the AI supply chain big dogs, such as ASML right there on Wednesday, TSMC on Thursday. And I think based on what we have seen and heard from the other AI chip companies, I'm not a betting man, and I'm not even going to pretend like I can predict the future, but I think it's going to be a bullish report from the both of them. And I think they'll be doing just fine. Unless, of course, there's going to be another escalation in the Middle East or somebody sending off a tweet that makes every butthole on Wall Street pucker with fear. If that's the case, and of course they could fall in the red, but I do think things are going to be good. And what else we've got going on? We also have Netflix on Thursday. They're going to be reporting, and they just recently increased their prices across the board. If you look at social media on Instagram, on TikTok, there's a lot of vocal, angry customers saying, oh, I'm going to cancel my subscription now. Okay. But I think that's the vocal minority. I think the 99% of the other folks, they're just going to continue to stay as a Netflix customer. So with Netflix, the main metric to keep an eye on, I think it's going to be the number of subscribers, and if it's still growing. If it is, the price hikes are going to be reflected in the next quarter, and their numbers are going to be astronomically beautiful. Because a company like Netflix, Costco, and to a lesser degree, Amazon, the number of subscribers, the Costco membership, Amazon Prime, that's what's important. Because as you can keep growing that number and the number of customers that are paying into being a subscriber, and then eventually you increase the prices for that subscription, it's almost a guaranteed toll booth business model that's really, really high quality and resilient. Now, obviously, if it's something fickle or something that's not crucial or essential, like maybe a Planet Fitness gym membership, of course, people are going to be quitting and the churn rate will be a little higher. But, dude, speaking of gym memberships, one of my biggest grievances, and it's one of the reasons why I do calisthenics and ruck marching and running. Have you ever tried to freaking cancel your gym membership at an LA Fitness, a Planet Fitness, or whatever commercial gym? Dude, it is like getting your wisdom teeth pulled out without any medication. It is such an annoying hassle of a procedure. Oh my gosh, just thinking about canceling a gym membership drives me up a wall. But anyways, I digress. With Netflix, I thought about investing into them. Remember how I kept talking about them on the channel? I kept eyeballing Netflix and Uber. And then with Netflix, I just, with the whole Warner Bros. Discovery merger situation, I feel like the stock market was kind of spooked out by them because of the debt they will tackle on. So sad as it is, I stayed on the sidelines. I was like, I knew they were undervalued. I didn't have the cojones to invest into them. I think it's a great business. So if you're invested into them, into Netflix, I can't fault you. Even though they don't pay a dividend, I think it's high quality. I love them. Now, Uber, on the other hand, I'm still eyeballing them. They're just, I know, for some of you watching this video, you might be like, dude, they're already an amazing price point. What are you waiting for? Based on the technical analysis indicators and my analysis, I still think Uber has a little bit more room to fall, at which point I'll think about pulling the trigger. As of right now, not right now. And then also on a high level, we have PepsiCo on Thursday, which is one of the better food CPG players out there. I would say the only other one that I think is a peer, or I guess slightly ahead of them, would be Coca-Cola. When it comes to PepsiCo, I just don't feel comfortable about their dividend situation. Because no matter how you look at it, I don't know how they're affording to finance it. It's just not sustainable. So, believe it or not, I actually sold out of them for a decent profit a few months ago. It was one of my core holdings for a handful of years. Looking into them a week ago, they announced that they were going to slash the prices of all their merchandise. Because for the longest time, they were trying to sell a bag of chips for $5, right? And for the consumer, they're like, dude, this can't be more than $2.99. Like, you got to be yanking on my chain. And so the consumers were buying less of Frito-Lay's products and anything else PepsiCo related. So they were like, you know what? We're just going to bite the bullet. We're going to decrease the prices to increase our volume falling off the shelves. So they're going to be sacrificing their margin. And when it comes to sacrificing the margin, for the most part, Wall Street does not like it. However, I think the market's going to like that strategy because I don't know about you, but if you think about human psychology, if the generic brand of chips is $2.99 and then the name brand chips are $2.99, you get the same quantity, volume, whatever, 12 ounces, you're usually going to gravitate and go with the name brand one, right? So I think PepsiCo is going to be losing a little bit of money to make money, and that's going to help bring back the customers that they lost. So ultimately, I think it's going to be a good thing. With that said, now let's jump into each day of the week and look at the companies in a little more detail. Kicking things off on Monday, April the 13th. Absolutely crazy to say that. I just feel like the other day it was January 2026, and even that sounds crazy. But isn't 13 some kind of an unlucky number? Like, especially if it's Friday the 13th. Luckily, it's Monday. And on Monday, there's actually one company worthy of calling out, and it's going to be the Fastenal company. They have a very interesting business model. So, on one hand, I used to be a strategy guy in corporate America, but I also used to work in supply chain and operations. So those are my two I guess, civilian work experiences. And then I was also an infantry officer. And now I do, I guess, finance-related YouTube content. It's kind of weird. But anyways, Fastenal, I actually worked pretty closely with them. I mean, right now they're trading multiple based on their forward EPS. It's a 40. So they're really expensive, and I wouldn't even consider buying into them. But just take a look at their share price total return for the past 5 years, 96% into the green without baking in their fat, juicy, sustainable dividend. What I mean by that is their dividend growth rate is 12.5%. Guys, that is so juicy, it almost makes me salivate. And if you take a look at it visually depicted, in 2016, you used to get 7 cents every quarter. Nothing to write home about, right? As you fast forward throughout the years, now it's 24 cents every quarter. My goodness gracious, that is just phenomenal. So when we talk about dividend compounders with cheese, Fastenal has to be a part of that conversation. Where are my manners? What exactly do they do? They're in the business of supplying supply chains, organizations, factories, manufacturing hubs with bolts, screws, supply, safety goggles, gloves, aprons, whatever it is that you need. And the catch is they usually operate vending machines or a small little, it's not a convenience store, but basically a Home Depot or a Lowe's, but in the form of a convenience store inside of that warehouse. So instead of somebody on the procurement team ordering it online and having it shipped to you, or worse yet, trying to get it through AliExpress or Temu, no, you can just walk 50 yards down the warehouse, go inside a Fastenal and get what you need, and it's right there for you. Kind of a stupid thing, right? But believe it or not, they crush. Their financials, their fundamentals, everything about them is superior. Very high quality. My whole thing is, I don't know if this is selfish. I don't know if you can say I'm rude or mean. They've been on my watch list for the longest time. I genuinely hope that the market overreacts and I have an opportunity to jump in. But at a 40 PE ratio, no way, Jose. The reason being is that if you just look at the Mag 7 and you consider Meta, Microsoft, Amazon, I guess we can also include Google into that conversation. Their trading in multiple is like an 18, 19, 20, 21. Okay? So how the heck would I ever want to buy a, I guess, industrial dividend compounder with a PE ratio of 40, right? I would rather just buy into the high quality Mag 7 that are on a discount. So that's Monday. And as we jump on over to Tuesday, I guess we already covered all of the big banks. We also have Johnson & Johnson. One second, my dogs are going crazy. Give me a second. My apologies, my wife was giving away newborn diapers to our Japanese neighbor because our daughter, too big for that. But anyways, as I don't like to invest into the pharmaceuticals. Reason being is that it's a moonshot bet, right? Depending on the drug pipeline. I have a dedicated video talking about why I don't invest into it. I don't want to disclose which company I used to work for, but it's one of the biggest pharmaceutical companies. And that's where I was a strategy leader, right? So having line of sight of the operations, the marketing, the production, and everything else related to it, I feel like with pharmaceuticals, that's not sleep well at night, right? Having said that, there are a few that I would label as a buy and hold because of how good their research pipeline is, because of how good their scientists are, because of how good the management team are. And I would say, I don't want to be biased, I don't want to be a jerk, but it would be Merck, it would be Eli Lilly, and it would be Johnson & Johnson. I'm so sorry, but Pfizer, they're not a part of that conversation. Eli Lilly, absolutely not. And some of the other ones, they might be on the border, they might be on the fence, but they're not a part of that conversation. So J&J, pretty high quality. Yes, they've got some scandals. Yes, they've had some litigation stuff that happened in the past, but time and time again, they come out ahead and they outperform. So we've got that on Tuesday. And we also have Albertsons. I think they're the third biggest grocery chain in the US because they have multiple brands operating there under them, right? I think number 2 is Kroger. And this might be a shocker to you, but the number 1 grocery retail chain based on the amount of dollars spent in their locations is actually Walmart. You can pause this video and fact check me right now. It's Walmart. So I said it in the past, and I'll say it again. It's not financial advice, but like if you ever come across a big sum of money, right, like a lottery, or you did a ridiculous margin call or a put, and you're a millionaire, obviously don't be reckless and try to double that again, right? Because if you lose all of that, you're an idiot. So what I used to say is you come across a lot of money, stop gambling, and instead put that money towards safe and steady buy and hold, slow and steady, boring investments that have a good dividend profile, right? The grocery stocks, yeah. The trash stocks like Republic Services or Waste Management, yeah. SCHD, yeah. That's what I would do, right? But I know some people out here, you win big in the casino or from a poly market bet, you'll probably roll it over and do another big gamble or bet and lose it all. But for me, that's what I would say, right? Put it into some boring old stock where 10 to 20, 30 years from now, it'll slowly be compounding without the risk of it going belly up, because utilities, trash, groceries, that's always going to be there, okay? And that's because I operate with the Maslow's hierarchy of needs. At the very bottom of the pyramid, that is something physiologically we will always need as consumers. Now, you might be like, well, hold on, why not individual brands or chips or beverage brands? And that's because I don't know who's going to be the winner out of them. So why not the platform? Because the grocery store, they don't care. They're going to be selling and they're going to be making money. And the margins are really low. Yes, I understand. But it's a boring and reliable type of investment, okay? So Albertsons, believe it or not, I'm going to be paying attention to them. I like them. I'm not saying that I'm going to invest into them, but, it's just something that I like to do, right? I like to keep up with companies that report their earnings because I feel like I'm always learning. And I've been doing this for a while now, right? 7 years. And I still feel like I'm improving by the week, especially with my methodology, my research, my game plan of how I do and synthesize and extrapolate data. I just feel like I'm improving. And that one aspect of that is by tuning into these earnings and then trying to figure out, okay, what's their fair intrinsic valuation now based on the information that we know now. Anyways, hopping off my tiny little soapbox that I got from Amazon, another company that's reporting their earnings is CarMax. And it's a used car retail chain. Well, not retail, it's a chain. They usually have like 2 to 3 CarMax dealerships in every major metropolitan area. It's sort of like Carvana, but with a bigger physical footprint presence. It's where you go to buy a car if you don't like the dealership negotiation showdown. Because CarMax is, I don't know if they were the first, but they're definitely pioneers and a poster child of the no pressure environment buying a car. And the out-the-door price is already finalized. So there's no haggling, there's no upselling, there's no, let me just run this by my finance manager and then playing you around for 4, 5, 6 hours. They tire you out. That way you just give in and you'll take the nasty car payment of $900 a month. The APR is going to be like 25%. You don't want to do that, okay? Don't do that, please. Speaking of which, I don't know. I'm so sorry. I have ADHD, which is why I go on these crazy rants. So I'm not shy about it. I talked about it quite a lot on the channel. The used car market is just bonkers. I think it's ridiculous because you'll have like 30-year-old Hondas that have 200,000 miles on the odometer going for 10 grand on Craigslist, on Facebook Marketplace. And don't even get me started with used car dealerships. They'll try to sell that exact same Honda for 12, 13, 14 grand. So my whole thing is, dude, I'm not here to try to hurt feelings, but if that's you on Facebook Marketplace, you're absolutely a jerk off. Because you know darn well that Honda, dude, that car is easily only $1,000 and a handshake. Because at the end of the day, the timing belt is all messed up. You know that there's a knock in the engine and the tires are darn near bald. So to put a price tag of anything above 2 grand is just absolutely criminal. That's just my opinion. And I get the whole Kelly Blue Book and the whole market rate. Oh, but that's what they're valued at, so I'm going to put it at 10 grand. It's like, dude, you know that's not right. Think about it. Who's the customer that's trying to buy a freaking 200,000 mile car? You think that's going to be someone that's well off? No, it's most likely going to be a struggling family, right? And to rip them off like that, I don't know, it just doesn't sit right with me, right? I sold both of my cars before moving to Japan 4.5 years ago. And the crazy part is, I looked up their valuations, right? And both of them had over 150, 160,000 miles. Easily some of the best cars I've ever had. And that's because I'm anal when it comes to inspecting cars. Because I used to be a big car guy when I was 15, 16, 17 years old. Yeah, just looking back those days, I was a weird dude, man. I was so into cars, especially with Hondas, Acuras. I was all about that life. Now I just don't give a darn about what kind of car I drive. As long as it gets me from point A to point B, that's all I care about, right? But back then, dude, I cared about it all. Anyways, my cars that I sold 4.5 years ago, their valuations in 2026, I'm not exaggerating, they have nearly doubled on the used car market. That makes no sense. You can't sit here with a straight face and tell me why my car that had 160,000 miles that are like, I don't know, 12, 13 years old should be going for double the price that I sold them for 4 years ago. It just makes no sense. However, in the used car space, this is where it kind of changes. EVs, electric vehicles, they seem to be the bargain, which I think is hilarious. Because brand new EVs, they go for what? $50,000, $60,000? Those exact same EVs on the used car market will go for $20,000. I looked into it, and it's because of the battery, the aging of it, the degradation, like the capacity. Is it going to be 100%, 90%, 70%? That's huge, because that means your range will get reduced from 200 down to 150, down to 125, right? But then also the outdated hardware fears. Because EVs, it's all about the technology in it. And the next year's model, it's going to make the previous year's model obsolete. Like, that's the narrative. I'm not saying I buy into it, because I think a freaking Tesla, Model S from like 2021, I still think it's serviceable and a good car. But you'll have some people saying, no, that thing doesn't have the latest and the greatest XYZ feature. So as a result, it's going to be 50, 60, 70% off. And I think that's a good deal. Reason being is because here's the thing. I don't think a 40-year-old Toyota should be going for 15 grand, okay? At about, what would you say, like 70, 80% of their MSRP. But for an EV that's only 2 to 3 years old to go for 50, 60, 70% off their MSRP, right, I would rather go with an EV. And I was never ever an EV kind of a guy. But anyway, speaking of which, did you know that the Chinese own the EV battery market? I don't know what happened this past week. I jumped down the rabbit hole, took off all my clothes, and I started researching about EVs. For the longest time, that market leader used to be Tesla. But globally, when we talk about Europe, Australia, other parts of Asia, more folks are buying Chinese EVs. They're not buying Teslas as much. As a matter of fact, I don't think Tesla is number 1 or 2. And believe it or not, over 50%, I think it's 53%, you can fact check me on that, it might be 57%, Anyways, over 50% of all car sales in China are now EVs. That boggles my mind. The Chinese are abandoning the gas vehicles at a rapid pace. The reason why I went down this rabbit hole, now I remember, it's because I thought of jumping into Honda. Because Honda's stock on surface level looks undervalued, right? But if you do the math, if the Chinese are not buying gas vehicles, that includes hybrid, but instead they're buying EVs, dude, this is terrible news for Honda, Toyota, Ford, GM, and other auto stocks. So if you're thinking about investing into car stocks, I'm not trying to tell anyone else what to do, but me personally, my conclusion, right, was to pause and to reflect, because China is the world's biggest car market. And if they're buying their own brands of EVs like Xiaomi and BYD, that's really, really bad news for Ford. That's really bad news for Chevrolet, Buick, Toyota, Honda. It's bad. But I think it makes all the sense because China's EVs, they sell for a fraction of the price of the other automakers that sell EVs. And that's because fundamentally, China is best in class for battery mining and refining. So even though their hardware and software might not be as good as Tesla's, their battery, they're able to produce it and procure it and manufacture it at a fraction of the cost. And the biggest burden, the biggest ticket item making an EV is the battery. And if they're able to do that at a fraction of the cost, they're able to put a butt in the seat of an EV, of a Xiaomi or a BYD, and get someone happy out the door. And then their neighbors are going to want that exact same EV for 18, 19, 20 grand brand new. So my conclusion, I'm not buying into Honda because I think the writing's on the wall, and I think the vehicle and car market is radically shifting and it's changing, which is crazy because I'm pro-American and I'm a capitalist guy to my very core. But pound for pound, I do not think we can compete with them. We can't. They're able to do it at a fraction of the cost. They have the raw materials, they have the labor, they have everything necessary to succeed and crush it in their space. So as of right now, in the US, we don't have any Chinese EVs. I think you might be able to import it if you're willing to pay the 200% tariffs on them. But we're able to not allow the Chinese to bring their cars over here. But I think it's only a matter of time. And once it does happen, dude, I think the automakers in the US, they're going to have to go through some more I don't even know if they're going to be allowed to because of monopolistic practices, but they're going to have to do some more mergers and team up just to survive. Because they're going to have to slash prices and do radical stuff, which means in 2026, brand new cars, they're not going to be built with the same quality like they were 30 years ago, right? Everything today is plastic junk, CVT engines that break down after 90,000 miles, and they're just junk. And the average car price for a new one is $50,000. That's the price tag, MSRP in the US. So can you imagine if they're going to try to compete with the Chinese, they're going to have to slash the prices? Can you just imagine how much lower quality the cars sold in the US are going to be? Dude, that just scares the tits off of me, right? And that's why, as Americans, we're going gung-ho for gas-powered vehicles. The oil and gas industry, they need the trucks on the road to be fueled by diesel. And for soccer moms driving minivans, to use gas. Because if not, bro, right? If the oil and gas field wants to stay relevant, they're going to need the cars to be gas dependent. But then also, we don't really have the EV infrastructure, the charging stations that are readily available across the nation. I think if you're from SoCal, San Francisco, parts of Austin, Texas, okay, whatever. But when we talk about Kansas, Oklahoma, North Dakota, and everywhere else in the U.S., no, right? So I don't really think EVs are a viable option, especially for road trips as well. But I mean, if you only commute to work, go to the grocery store, and you're not really looking to go on road trips and whatnot, I think an EV makes perfect sense, especially if you're eyeballing for a new car, or I guess a used car in this crazy market right now. Anyways, let's go back to the stocks reporting earnings. Man, I had to catch my train of thought. I was like, why was I talking about cars again? So with CarMax, I did some research into, is it a good opportunity? What's the catalyst? I think right now they're going to be screwed. The reason being is that their inventory, they're buying these expensive ass used cars to sell them for an expensive price. Correct? But what we're finding out is that the consumers are starting to tap out. They're saying, you know what? I'm just going to have to drive another year or two with my old car because the price tags are getting ridiculous, which means if you take a look at the recent data released by JD Power or another car survey market research just a few weeks ago, almost every single car brand, their sales have dropped like 20-30% year over year. So the inventory of cars, it's sitting on their lots longer. And so I think that's also going to manifest in the used car market for CarMax. I just feel scared for them because if they were able to scoop up a lot of these vehicles while they're selling for a fraction of the cost and they're upselling it, okay, the argument for them, okay, I get it. But the fact that they're buying used cars for a pretty penny and then trying to sell them for a pretty penny, I just feel like that's a recipe for disaster. I don't know. That's just my thinking. So I'm not going to be investing into them. They also don't pay a dividend. But as we jump on over to Wednesday, we already talked about the banks. We already talked about the semiconductor chip equipment manufacturer, ASML. Did I tell you guys my ranking for the equipment players? Number 1 is Lam Research. Number 2 is Applied Materials. And number 3 is ASML. But that's not to say ASML is booty. I think Lam Research is S tier, Applied Materials A, and I think ASML is a B. And a B for me is pretty good. But we also, on Wednesday, we also have Progressive, ticker symbol PGR. It's one of my core holdings as disclosed in the public portfolio series, which you should check it out, the Cheese portfolio series. Right now, let's click and talk about it. We zoom back 1 year. They're currently trading for about $194, which means they're bouncing around their 1 year low. And that's because the markets are pricing in with the price of oil barrels spiking. I don't know, depending on when you watch this video, it could be $110 a barrel, it could be $80 a barrel, but whatever, it's spiking, right? It causes inflation across the board for everything, right? Transportation, shipping, everything, the price will go up if the price of oil goes up. But specifically in regards to Progressive, all petroleum-based products will go up, okay? So if people are making insurance claims to fix their car bumpers, to repair panels, to paint damages that would otherwise cost $500, but now, because of inflation, it's going to be $1,000, think about it. As an insurance company, that's going to hurt their margins, right? Exact same situation with what was happening to the health insurance players. Inflation is also permeating into the medical field. The cost of every treatment, service, surgery has also gone up, and so their margins are being crushed as well. Then again, we know that the federal interest rates, they might not get cut this year. So, and I don't know, we also heard that there's talks of increasing the federal interest rate, which I think is kind of crazy. So even though they have a headwind, that would also be a tailwind for Progressive. So there's some good and there's some bad with them. Why would that be a tailwind? Why interest rates going up? Well, why is that good? Because they can get a bigger and a better ROI on their investment income. That is, let me jump on over and show you on their balance sheet. That's reflected right there, total investments, because they take the cash on the books and they put it into, I guess, relatively cash liquid stuff like CDs, T-bills, money market funds in order to get some money from the money that are on their books. That's one of the core drivers for an insurance company. However, their main bread and butter is from the premiums that they charge their customers. That way your crappy little Toyota Camry can continue to be insured for another 6 months. Which, by the way, my car insurance before moving to Japan, I used to pay $21 a month for one of my cars. My other cars, it was like $30, $31. I'm sure that's not the case right now in the US, right? I mean, you guys can put me on and let me know. It also depends on what vehicle you drive, your history. I have a pretty clean history, and I was driving a dingy little Honda, so maybe that's why it was so cheap. But anyways, if the federal interest rates go up or they stay sticky at about 3 point whatever percent, because of that, they can also raise premiums, which means they'll be making more money. So as crazy as it might sound, depending on how things go on Wednesday, I may double down on my position that's relatively flat right now. I'm not in the green, and I think I'm slightly in the red with them, but I guess we'll see. So Progressive, I really like them. Just right now with the whole Middle East conflict, it's because prior to that, dude, they were thriving, right? They were doing good, and then once that whole situation unfolded, they started selling off. It is what it is. Moving on to Thursday, we also have another insurance player, Travelers. By the way, if you don't know, I'm a huge fan of the insurance stocks. I used to not really care about them, but then I was tuning into some of the annual Berkshire Hathaway meetings from like the 1980s and 1990s, and Warren Buffett kept going on and on and on about insurance stocks and why he loves them so much. And then I thought to myself, well, hey, I look up to the guy a lot, and if he likes them, maybe there's some merit to it. And once I started researching about the industry and the landscape, I finally see eye to eye with Warren Buffett, and that's why I invest into insurance stocks. As a matter of fact, I have an insurance stock breakdown video, but also where I rank all the big names in it. You should watch that video after this one if you have not already. So Travelers, I think Progressive, they're S tier. From off the top of my head, I think Travelers is in the A bucket, maybe B+. It's very high quality. But we also have Prologis. It's a REIT that rents out warehouses and factories for the operations and supply chain space. This is a good one. There's Abbott Laboratories. They're also bouncing around their 1-year low right now. This one I really want to buy in. They're in the business of selling baby formula, medical devices such as monitoring your glucose, insulin, diabetes, and all that kind of stuff. And they also sell some other random medical products. I really like them. As a matter of fact, I can't remember off the top of my head. I think my entry price to jump in is around $89, and I think right now they're $100. So they would have to fall by $11 or so for me to jump in. I can't remember if it's 89 or not, but Abbott is definitely one that I'm going to be monitoring because I think it's a buy and hold. I really like them. In terms of the medical device space, I think their only real competitors would be Edwards Lifesciences, Medtronic, and Johnson & Johnson. And then I think there's one more. I can't remember. Anyways, Thursday, we also have, let's see. Okay, we can jump on over to Friday. Anything crazy? We got some regional banks. We also have Ally Financial. We have Badger Meter. So they're in the business of selling sanitation, water meters, and other equipment to the water utility stocks, which is kind of a funny business model, right? And they're actually on my watch list, but I think they're a little too expensive for me. So Badger Meter, I wouldn't mind jumping in, but I think the price would need to fall a lot further. As a matter of fact, in the water space, there's another company that let me see if I can type them in. It's Veralto. They used to be a part of gosh, is this Thermo Fisher or, but anyways, they do almost the exact same thing as Badger Meter, but I think they are at a more fair valuation than Badger Meter. No, it's not Thermo Fisher. Let me think about this. I remember Danaher. So they were a spinoff from Danaher. Funny enough, Danaher, when I used to work in the supply chain space, it's a company that I had an offer to join, and I turned them down. Veralto, I think, is really high quality. Really like them. If I have the opportunity to buy into them off Friday, I would be a very happy camper. And then, of course, I'd be like, hey, guys, in the Public Cheese Portfolio series, I finally bought into a new stock. So actually, this week, there's the potential for me to open up a new position in a couple names, right? We've got, well, to a lesser degree, Badger Meter. We've got Abbott Laboratories. And then Fastenal, I would need a miracle to happen for them to drop down to at least a trading multiple of like a 20 or a 19 or an 18. At a 40, that's a no way, Jose. Was there anybody else? Do you guys remember? I don't know about Albertsons. I mean, they're good, just not in my current state. I think right now the name of the game for me is CAGR and total return, which a huge component and ingredient is the dividends, right? With Albertsons, I just don't know if I would be able to outperform the S&P 500, which is the benchmark that I like to compare myself to. Because I always say, if I can't beat the market, I'm going to throw in the towel, SCHD, VU, and call it a day. But as I continue to beat the market, I'm just going to continue to pick and choose individual stocks. But the moment that I start losing consecutively, consistently, or if my life gets a little too busy, then yes, I'm going to yield to ETFs. But with Albertsons, just not in my current priorities, but also with my goals. So anyways, that just about wraps it up. Before I head out of here, the other day, dude, I got to tell you this story. I was changing my baby girl's diaper. She poops like 5, 6, sometimes 8 times a day. Dude, I don't know how you could have massive poop sessions like that all day long. Like, it's crazy. But at least, hey, her bowel system is working, digestive system is rocking, so that's good, right? And I was wiping her booty hole clean to make sure, there's no fecal matter left over. I was inspecting, and I kid you not, I am not exaggerating, okay? She let out a fudge bubble. A gust of fart went directly into my mouth. And I'm telling you right now, I'm not a liar. That's the first time in my life somebody has farted into my mouth. So after getting her situated, dude, I sprinted to the sink and I flushed my mouth for a good 5 minutes. Like, I literally thought I was going to vomit. Can you imagine someone farting into your mouth? I'll tell you right now, any other person, if you were to fart in my face, dude, I would put you into an arm bar. I'd have to probably break your freaking arm and pull it out of your shoulder socket. I would be so angry. But with her, dude, I was laughing. I was like, I can't believe it. This is my life now. Right? I'm a stay-at-home dad. Because it's hard to get mad at a freaking 5-month-old, right? She doesn't even know what she's doing. So I was like, think about it. She poops her pants. How could I get mad at her? And she has a smile and a face that's cute as a button. So I'm like, kids do the darndest things, right? And she also started eating solids, which is kind of crazy. We started giving her some avocado, a little bit of eggs, a little bit of sweet potato. Because apparently, the more diversity of food that you introduce to a baby in their first year of life, the less likely they are to develop allergies. The reason being that millennials are so jacked up, like if you were born in the 1980s or in the 1990s like I was, so many of us are jacked up because the golden truth at the time was to not allow kids to go near peanut butter and all this other stuff. And as a result, we all ended up developing allergies, right? It's stupid. So now the kosher advice is to try to expose them to as much a vast array of food as possible so that their immune systems can develop. So that's what we're doing. Other than that, in next week's Compounder Corner episode, I'll circle back on the major announcement that I hinted at last week. Had some time to sit with it, think about it, and I think it's going to be good for everybody. For those of you that were like, oh, you're going to be dude, no. I mean, that would be cool, but no, we're not having another child, okay? Not to burst the bubble on that one, but it's going to be a major announcement that's also going to radically change the channel because there's so many things that I want to do, but I cannot because I live in Japan, right? Like I need to be in the US so I can hit the ground running with some of the stuff that I'm thinking about. And oh yeah, also to follow through on what I was talking about last week, I decided not to buy any cybersecurity stock or ETF like Hack, Cyber. There were 4 ETFs that I was looking into researching, and ultimately I was like, you know what? I'm just going to buy more shares of Microsoft. And the reason why the cybersecurity stocks were selling off is because Anthropic released a new version or a patch update, and now they're able to do more cybersecurity stuff. Then I was like, could be a good opportunity. But you know what? I'm just going to double down on Microsoft because they also have a huge exposure in hand in cybersecurity, making sure that your Windows, your PC, your cloud is secure. So for me, I consider Microsoft my exposure to cybersecurity, and I think I'll be okay. But anyways, I love you guys. Stay safe. Good luck in the stock market this week, and it was cool hanging out with you. I'll talk to you guys really soon. See ya.